Continuing to work our way through the winners and the losers in the retail sector today as we get more news from the various players. Chuck Grom is with us and Stacey Widlitz. Stacey, I just want to touch on where we are with Barnes & Noble. It lost, what, a quarter of its market capitalisation today. What remains on it on that double whammy, saying, A, it may spin off its Nook business, and secondly, that it's reducing estimates because its Nook business isn't doing so well. What view do you take?
Well, I think the best analogy here is look at Best Buy. So Circuit City went out of business several years ago, and look at what Best Buy is doing. Really, they're still limping along here. Borders just went out of business. Barnes & Noble's limping along. The book business is just migrating online. We know that here. So they're trying to spin off potentially the Nook and separate some value here and isolate certainly a business that's low margin, that's migrating away from the store. So it's a real issue here.
At what point do you think it might become a buy? I mean, there is value in the assets there, clearly.
Well, you know, if you look at Barnes & Noble stores, they're leased. They have 10 to 15 years on average. So you have to look at the business and say, where is it going? You know, what is the long term here? They have over 1,000 stores. How many should they really have? Where is the industry going? And again, you look at the analogy with Circuit City and Best Buy. Borders is out. So, you know, what is really the long term potential here for the book business? It's a real structural issue.
Chuck, let's turn back to a couple of the companies that you think are winners here, and you, like many people, see the high end doing well, the low end doing well. Among your buy ratings, Nordstrom, Macy's, and Costco, which isn't really high end, but I would never have guessed 5 years ago that Macy's would be doing as well as it is and on so many buy lists. Why?
Yeah, it's a great point. I mean, I remember three years ago covering the stock in the high single digits and nobody really liking it. And now, you know, it certainly seems kind of crowded, but when you take a step back and you look at a 6.2 comp relative to their two largest peers of roughly 0, with a doubling of the dividend today and a $1 billion increase in the buyback, and then you layer in a multiple that's under 10 times, there's a lot of reasons to still like this stock. And, you know, they had a coming Jesus back, you know, a couple years ago in terms of, you know, really focusing on localization in their stores, and we think that the My Macy's strategy begins to transition to, you know, more of an omni-channel strategy over the next couple of years. So, you know, they really had you know, they really figured things out a couple of years ago, and you know, we think that continues over the next couple of years.
Stacey, that was a stock you liked, if I'm recalling correctly.
Yes, and you know, Tyler, it's no coincidence here that Macy's has been investing in their business. They've been investing in their people and their business and the multi-channel approach here. That's why their comps have been consistent. Now, on the flip side, you look at a JCPenney, you look at a Sears, they have not been investing in their stores. It's not a coincidence that their comps are where they are. So the companies that continue to invest in their people and their product are winning, like Limited, like Macy's, while the others are lagging behind.
Fascinating. Thanks so much, guys.